Greetings, everyone. This is Jeff Schechter, aka Shecky, from the High Return Real Estate Show, coming to you live from Indianapolis, Indiana. And today we have got just the most amazing guest for you. This is a very, very special woman. She was actually named one of Goldman Sachs' 100 most intriguing entrepreneurs 2 years in a row. And this woman has the dream lifestyle of living on the beach in Malibu, California. She's a really, really amazing woman. I'm going to come back and introduce you to her in a minute after the break. But today we're going to talk about how to really reconcile both your logical brain and your emotional brain. So it's really how to be data-driven and passionate about real estate investing at the same time. So we'll see you in just a minute. Look forward to a really, really great show. Welcome to the High Return Real Estate Show, the podcast for heavy hitters. 2 men, 1 mission. It's time to build your empire. Welcome back, everybody. We've got an amazing guest today. She is the founder of the Real Wealth Network, and her name is Kathy Fettke. Hello, Kathy.
Hi.
How are you?
I'm having a wonderful day. Thank you.
That's great. We are so excited to have you. I've got so many great questions for you, and I just some of the stuff that you've been involved in, obviously after that last meltdown and being, voted one of the 100 most intriguing entrepreneurs 2 years in a row. And, it's just really cool what you've been up to. Can you talk just for a little bit about, I got a million other questions for you, but can you talk a little bit just about that and how that came to be and what were some of the great things that came out of that?
Sure. Oh my gosh, it was such a shock. I got this letter in the mail with this big, beautiful crystal award. It said top 100 most intriguing entrepreneurs by Goldman Sachs. And I didn't know what it was. I thought it was some kind of sales pitch. So I literally just put it aside and threw the letter away. But my daughter, who at the time was a high school student, or maybe she was a college student studying business, she pulled the letter out of the garbage and said, "Mom, this is signed by Lloyd Blankfein, the CEO of Goldman Sachs. You might want to call him back."
Yeah.
So I thought, all right, what's the catch? So I called and said, thanks for the award. And it looks like there's a 3-day award ceremony. What's the catch? What you want me to invest in something, or you want to pay? What do you want? And the lady goes, "Oh, no, we just want to honor you for the work that your company's done to help clean up the mess in America and helping investors get the courage to go into these dilapidated markets that had, house after house after house with boarded windows and doors and just nice neighborhoods that turned into ghost towns and worse, turned into, places for transients to break in and, and enter and live, that we were able to get investors to go in and buy those houses and fix them up and revive these neighborhoods. And so they wanted, she's like, "We just want you to award you." And so I went and, was greeted by Lloyd Blankfein himself and the whole upper echelon of Goldman Sachs. The other winners of this award were, the Uber guys and the Solar City and Box and Dropbox. I mean, it was phenomenal. This was in 2012. So that was, one of the most exciting moments of my life. And then it happened the second year in a row. So a lot of people were talking about how Hillary Clinton got paid by Goldman Sachs to speak. And that was one of the events. I was there.
Wow.
At the event that Hillary spoke at, where she got so much flack for being involved with Goldman Sachs. So very, very interesting. And the kind of the funniest moment was when I stood there and I didn't know who anybody was. And I said, "This is so funny because on my show, the Real Wealth Show, I talk about how I think Goldman Sachs actually caused the housing crisis. So I'm surprised they gave me this award." And all of a sudden, the wind blew the name tag around so I could see who it was, and I was talking to the CEO. I was talking to
Wow.
Lloyd. So I just kind of stopped talking at that point.
Yeah, it's the universe is very kind, right? So
Yeah,
it's interesting how everything kind of comes around full circle, and I'm sure that there's plenty of people that would agree with you that maybe they did cause that mess, and who knows, maybe they're just trying to not to say that you're not deserving, you're of course deserving, but who knows what their motivations are behind that. But the cool
Oh, I
thing
think they
is,
were trying to, give a Band-Aid, offer a, a feather for the for the yeah, exactly, to try to paint a pretty picture of how they were now helping out with the mess they created.
yeah.
That was my take on it. Yes.
Yeah, it's what do they call that? Reputation management, I think is what they
Yes.
call it. Yeah, so
Yeah.
that's today's term for it.
Right.
But it's just such a interesting, how that happened for you and how some of the things have evolved with your real estate career. But I noticed that you got started as a life coach, which I find also really interesting. How is that played out, and how did you evolve from that into doing more real estate investing, and how has that helped or hurt you from a standpoint of dealing with other investors?
With the whole fallout of the housing meltdown.
No, I'm asking
Oh.
about your start as a life coach.
Oh, as a life coach. Yes. Oh, I'm
Yeah,
sorry.
yeah, and I'm
Um,
kind of curious
uh,
as
yeah.
to, A, how you got started in that, and B, how does that really translate into
Oh.
real estate investing, negotiating, helping other investors, things like that? I mean, like, has it helped you or has it hurt you? Because that's
Oh my gosh.
it's kind of
Yeah.
a touchy-feely sort of career, and it's not really
Yeah.
very data-driven. So I'm kind of curious how you
Yeah. It's a great
reconcile that
question.
too.
My husband took this coaches training institute, probably 20 years ago. And I like, what is that? And he said, well, it's this new career, and you learn how to coach people to achieve their dreams. And I thought it sounded pretty silly myself, but he took it and he came back just a transformed man. I really just, I couldn't believe the way he was communicating with me in a different way than most typical, strong alpha men would do. So, usually an alpha man wants to fix problems, and so rather than listen to their wife, they suddenly give a solution that they think is the right solution. And all of a sudden, he's asking me questions. He comes home from this training, and if I complained about something, he would look at me and say, "Oh, okay, what could what could you do about that?" And and asking really powerful questions that helped me find the solution. So I thought, all right, whatever they just did to him, I need to learn.
Yeah,
So I went and took the course, and we both got certified. And he ended up becoming one of the top business coaches in the world. He wrote a book. He was the president of the ICF that formed the Association for Coaches, and he just helped business owners double, if not triple, their revenue while living a more quality lifestyle, just from the power of simple questions. And I did the same. So in answer to your question, it has only helped, because the best and most powerful thing you can do in any relationship is ask questions, and powerful questions, and stop trying to come to conclusions or making assumptions or even trying to teach. Find out where the pain point is, find out what that person really wants, and then, ask what would be the perfect scenario and outcome. So when it comes to, I truly believe that's one of the reasons why the Real Wealth Network grew so quickly, because that's the approach we took with members. Is like, what do you want? What's stopping you? What are some simple steps you could take to get moving and get in the right direction? And how will we know? What will you put in place to make sure this happens?
that's
That
great.
accountability piece.
Yeah, I mean, so it's very questions always very, very powerful. I spend
Mm-hmm.
a big part of my day speaking with investors, and I just find, like, I can tell them about all the stuff we do, but we've got websites and presentations that do that, and I find that when I do get on the phone with an investor and really just ask them who they are and what they're all about and what their motivations are, and really get to know what they're trying to accomplish, and ask those same kind of empowering questions. Well, what needs to happen for you to accomplish that? Those calls are always they're just so much at a higher level, so much higher vibe, and there's always better results that come out of them. It's just
Mm-hmm.
it's amazing what happens when you try to kind of stop selling and get into the mode of just like, how can I help you?
Mm-hmm. Yeah, absolutely.
So how did you go from that, life coach moniker? And I'm guessing you were probably doing that for a living at one time. How did you transition from that into real estate investing?
Sure, it was super by accident. So while I was a personal coach, my husband was doing it full time. I was doing it part time as a stay-at-home mom. It was a perfect scenario because I could be home with my kids, but when they were napping, I could take coaching calls and
Yeah.
help mostly women build their business and create a more well-balanced lifestyle. And so that was my focus. But also, I've always been in the media. I have my degree in broadcast communications and worked at CNN, KTVU, and Fox News. And when I got married and had children, I didn't want to be chasing fires or murderers anymore. I wanted to raise my kids.
Imagine that.
So,
Yeah.
yeah. And so, but I kept a radio show and KSFO and KNEW in San Francisco. And it was really a coaching kind of show. I would interview people that were, you know, had a dream, and I would coach them live on how to achieve that dream. And I had contests, and it was a really cool show. But, and all that was great. It didn't really make me any money, but we didn't really need money because Rich's career was taking off. He had just written a book called Extreme Success, and it was based on his coaching, coaching many clients and how they were able to become so successful overnight just by shifting a few minor things. So he ended up doing this book tour and was, on a national book tour on national media. So I hadn't really seen him for about a month. And then he came home and said, he just noticed there was a freckle that he hadn't seen before. And this guy's like a redhead with a million freckles. So I don't know how he saw this one freckle, but he did. And he went to get it tested, and it turned out to be melanoma. And he did more tests and was told he had 6 months to live.
Jeez.
They thought it had spread. Melanoma is very deadly once it spreads. And so there we were at the top of our game, everything going amazing, just bought a huge new house, 2 young kids. His career was just on fire. And then we get that news. So it's like, okay. So everything changed. And I said, all right, you stay home and get better. I'm going to figure out how to take care of our finances. And we certainly burned through all our savings and investments through the medical bills at that point. So we just started renting out rooms in this big new house we had to kind of help cover. So we sort of became accidental landlords. And I just like rented out every nook and cranny. It was like a 7-bedroom house or something, and way over our heads, but fine if everything was going fine. But boy, you have a few bad months, and we were in trouble, like a lot of people. And that's where we ended up. So because the house was so big, it was actually a bonus because there was so much room to rent out. So we were like basically living with like 6 people, but they were pretty much covering all our expenses, which made it okay. And that got us through the tough times and kind of taught us how to be landlords. In the meantime, I switched my show from, kind of a coaching show to, oh my gosh, what do I do now kind of show, which I was like, all right, how do you make money? And how do you make passive income? And how do I continue my amazing lifestyle and be a stay-at-home mom while still creating income? So I just started interviewing people who've done that, just people who've created massive wealth through different solutions. And I found a trend. A lot of people either started a business, and most invested in real estate. And so that was what I learned. And that's what my audience started learning. And all of a sudden the show just took off. And then I ended up getting a sponsor who ended up, I charged a ton of money because our audience was starting to grow, and that ended up paying more of our bills. But even more importantly, that sponsor was a mortgage broker, and it was, 2003, 2004. So you could make a lot of money in mortgages in California.
Anywhere. That was a good time to be in the mortgage business for sure.
Oh my gosh. So I didn't know anything about that kind of money. I was used to, normal money, but we had such a successful show at that point that as a sponsor, it worked. And his phones were ringing off the hook and he couldn't keep up. And he said, look, he pulls out 3 checks from his wallet. One's for $10,000, one's for $11,000, one's for $12,000. And he goes, yeah, I just made these today. If you want to go get your license, you can take these calls and I'll be your broker and I'll just take, 20% or whatever. Because this is just, the sponsorship's been too successful and I can't handle it. So I said, okay. So I ran out, got my real estate license, and I just started doing loans. My very first loan was $1 million loan. I didn't know what I was doing, but I got through it and made like $10,000, just pushing some paper. Back then it wasn't that hard.
Yeah.
So
good for you.
Yeah. So that was a game changer for us financially. And that really helped. And the good news is the doctor was wrong and Rich is fine and healthy today. But we didn't know. And the not knowing is what got me out, out of the house and kind of frantically trying to find solutions.
Yeah, but I'm glad to hear Rich is okay. But what's interesting about that whole story is that, really that story exists among probably millions of people around the world where things are going well, but there's something going on behind the scenes that maybe they don't even know about, or you don't know how things are going to turn out. And I feel like the lesson there is that you just don't know. It's always better to be smart and be prepared and have, ways to have passive income and do those kinds of things, hopefully before you find out bad news. And I'm not a negative guy. I'm not saying that, I'm not peddling, fear here by any means. Yeah. But I do believe that we should be, smart about things, especially when it comes to finances and passive income and things like that, because there's always unknowns, always.
Right. Absolutely.
So that led you, now you're a real estate agent, and now obviously somewhere from there to now, you start doing some of your own real estate deals. And I'm kind of curious how you rolled into that.
Yeah, sure. So, all of a sudden I was one of the busiest mortgage brokers in the San Francisco Bay Area. Our show had taken off, and then my husband said, hey, there's this new thing called iTunes. There's a podcast. This was back, over 10 years ago. And he goes, let's just take your show and put it on iTunes and see what happens. It's free. And all of a sudden I had listeners around the world when I only had a San Francisco audience before. Yeah. Just overnight, I had just this huge audience, and it just took off because I was one of the first podcasts on iTunes. And so there wasn't much competition. It was just me and a few other real estate podcasts.
That's great.
Yeah. So it just took off, and all these people, wanted to buy real estate, and they were hearing the show. And back at the time, we were teaching people that California was in a bubble, which became really obvious because I was doing loans and going, none of these loans make sense. This is crazy. This person has no possible way they can pay this back. They know it. I've gone over it with them, but they want to do it anyway. It was just nuts. And the liar loans and the bank saying, just change their income. But that's their income. It's okay. They'll qualify if you change their income. So it was nuts. And I would say, but that's fraud. I can't do that. And they go, so the client would say, well, I'll go to the mortgage broker on the desk next to you and they'll do it.
Yeah.
So anyway, I knew something was seriously wrong. And I had experts on the Real Wealth show, like Robert Kiyosaki, saying, oh, yeah, something's definitely wrong. It's going to blow up soon.
Yeah.
So, he said, sell in all the high price bubble markets and get into Texas, which was 26% undervalued in the mid 2000s and yet had the highest job and population growth in the country. But the average home price was like $130,000 or something. So we could buy brand new A-class properties in the best parts of town in the path of progress where the jobs were for, $145,000 to $150,000. It was amazing,
Beautiful.
Because it was, So we did that. Rich and I did that. And then we helped a bunch of other people sell their California assets and exchange them for Texas properties. And all of a sudden I thought, I think we have a new business. People want to know, they don't just want loans. They want to know where to buy property. So then we kind of switched to the realtor side, which was to partner with realtors in other areas to help the members of Real Wealth Network, which was what we called our group by then.
Yeah.
We'd kind of created this and helped people understand market cycles, get out of the bubble, and get into emerging markets and find cash flow. And that's what we did, and that's what we continue to do.
That's awesome. Love it.
Yeah.
During these last few years, it's kind of more like, the lightning round question, but, what was your best deal? What was your worst deal?
Yeah. Oh boy. Personally, or
Well, I'm just kind of curious, just from a standpoint of structure, not necessarily yours. I mean, it certainly could be one of your investors, but I always love a good story, and I'm wondering, what would you say is the worst deal, maybe the dumbest deal you ever did, and maybe the easiest and smartest deal you ever did?
yeah. So I made a big mistake back in 2009, I think, and I think it was in your market. You're in Indianapolis, right?
Yeah. Hmm.
Yeah. So Indianapolis got hit hard, at least certain sectors of it during the recession. There were neighborhoods near the well, just kind of by the racetrack that it really got decimated.
Yeah.
And some neighborhoods that were okay at one time just turned real bad because you have all these boarded up homes, and that attracted vagrants and drug dealers and people that shouldn't be there, and they'd break into these homes. I mean, I'm sure you remember they would live in these homes and do their drugs there and their parties. And if you bought the foreclosure, you might end up with a few vagrants inside, and oftentimes a few dead bodies of people who OD'd, or you'd have the houses burned down because people would light fires in the living room, and they'd use the toilets that didn't flush. I mean, it was just a mess. Do you remember those days, right?
Well, thankfully, I was not in Indy then. Thankfully,
Okay.
I was actually in Texas for almost all my adult life, so I was there during the heyday when the Californians that you were advising were buying up properties in the neighborhoods that I was living in. So I was there for a lot of growth, and more particularly in Austin, and which has gone through just some incredible growth. And but moved to Indy obviously because we were seeing some things here as far as cash flow with our own business, and some of the things that we were able to generate with our own clients and the passive income that we could create for them. There was just some really amazing price to rent ratios here, or there are now. But yes, there's no question, Kathy, that I've heard stories, and obviously many of the people that are on our team that have lived through that. Thankfully, Indy is a much different place now. But yeah, there were some pretty rough times. I don't think it was just Indy. I think it was all across the Midwest, and I know to a certain extent it was even worse in Detroit. But yeah, there was definitely some major cities in the U.S. that were really having a tough time as a result of that meltdown.
Oh yeah, it was really bad. So I went to Indianapolis and met with several groups there that were buying these foreclosures, and I mean, these houses were, some of them were just being given away.
Yeah.
Many were under $10,000. They were scary. It was rough. But, we had an investor base, a lot of Australians who were willing to take that risk, and because the homes were so cheap.
Yeah.
So that, I would say, was a mistake looking back. I mean, it was really hard to gauge. Those were rough times. Had I done it differently, I would have just bought in my own hometown of Walnut Creek and Concord, because properties were so cheap then. But they didn't really cash flow that well.
Yeah.
And the difference between a $200,000 home versus a $15,000 one,
Yeah.
there was just a lot of interest. So,
Yeah.
We just kind of dove in there, and we had to trust. I found a team, and we had to trust that local team to buy these properties and renovate. And what we discovered was that a lot of people discovered this, trying to renovate a property when the world was falling apart. I mean, people had lost their jobs. They were living in tents. We didn't know if we would be the United States of America any longer. I mean, it was crazy. The banks were melting down. Nobody knew what was next. And,
Yeah.
and so, in that environment, there was massive theft. It was chaos. So, an investor would buy a house and have a team renovating, and the whole house would get renovated, and then the next day everything inside it would be stolen. Including the copper and the AC units,
Yeah.
and the toilets, the lights, everything.
Yeah.
Or you would get it all renovated, rent it out, and that whoever you rented it out to would steal everything and be gone. I mean, it was just a moving target and extremely difficult. The same happened in certain suburbs of Dallas that were really fine before the recession, and then because of all the foreclosures, just turned in, went from B minus to like D neighborhoods.
Yeah.
So
Yeah, they just skipped
yeah,
right over C. I know.
yeah,
Yeah, it's
they
crazy.
skipped right over C.
Yeah, it's
So
crazy.
those were mistakes. I mean, the investors knew the risk they were taking, but nobody wants to see anyone struggle, and that was hard. That was really
Yeah.
hard.
Yeah, for
Yeah.
sure. So what would you say was your easiest, smoothest deal that you just kind of wiggled your way into that turned out really nice?
It was all well, in terms of single family homes, it was all the Dallas properties. It was the stuff that I did. Rich and I bought like 8 or 9 properties in a little town called Rockwall, Texas.
Oh yeah.
It was, yeah, it was like, I don't know, 20 miles outside of Dallas. But back then, you had to drive around this lake to get to Dallas, and it took an hour. But we knew that freeway was coming in around the other side of the lake that would make the commute 20 minutes instead of an hour. So cute little town, beautiful brand new houses. We were able to buy them for $140,000 and even less sometimes, brand new. And we would rent them for, far more than the mortgage. And these people would never leave because the schools were excellent. They were A properties. It was A
Wow.
properties that cash flowed.
Wow.
They're worth double or triple now.
Yeah.
So the people that followed me in that direction, they weren't getting massive discounts the way that were in some of these foreclosure deals, but they also weren't dealing with any of the trouble,
Yeah, yeah, and
Yeah.
you're getting a beautiful property, and even if the cash flow isn't terrific, you're getting cash flow and appreciation, which is, I mean, that's sort of like the golden egg for every investor.
Yeah.
So that's a pretty cool thing. So you've done so many cool things and so many different things. I'm kind of curious to know, and I'm sure the listeners are too, but like, what's your favorite real estate investing strategy? Like, when we talk about, like, my business partner Jack, who's an amazing guy, who's, we always have this conversation about staying in our lane, right? Like, there's
Hmm.
certain things that we do really well. There's a lot of things that we don't do at all or don't do very well, and we just kind of stay in our lane. So I'm kind of curious, like, if you were to stay in your lane, do best, like, what's your best strategy? What are you best
Hmm.
at?
I wish I could say that I stay in my lane, but by the nature of real estate, I don't. Because what I guess you could say my lane is understanding where we are in the market cycle and doing what makes sense in that market cycle. So, when foreclosures were abundant and cheap, that was my lane.
Yeah.
Now they're not. So, trying to find a bunch of foreclosures is a waste of time, and going to auctions makes no sense. I mean, it's just not where it's at anymore. And so you kind of look at what's the climate today. Well, today we have the absolute opposite problem. We don't have enough inventory. Back then, it was nothing but inventory. So,
Yeah.
my strength was encouraging investors to buy stuff, saying, "Hey, look, nobody else is buying it. We can negotiate ridiculous deals." It's a buyer's market. We had a strong buyer group. Now it's a seller's market. So what do you do in a seller's market? Well, a bunch of buyers isn't that valuable because everybody's trying to buy from all around the world, and there's very limited supply. So what do you want to do? You want to be on the supply side. And so we have partnered with developers, and we are building, and we're directing investors into that. How do you entitle land? How do you use your self-directed IRA in situations like that? How,
Yeah. Great
how do we know
strategy.
we're picking the right? Yeah. So that's where we are right now. In addition to still finding the best markets for cash flow,
Yeah.
where is it still emerging? Where can you still get good returns? Where should you sell, and get out of the bubble market while you can?
Yeah. So it sounds
So
to
yeah.
me, yeah, and I'm sorry to interrupt. It sounds to me like you would agree that I mean, obviously prices are fairly high right now. I'm not talking about Indy specifically. I'm talking about generally around the country and many of the banking and lending processes that are going on. It sounds to me like you feel like there's another correction coming. And, if you agree or disagree, fine. And I'm just kind of curious how you feel about that. And if you do agree, how should investors be investing right now to build portfolios that will survive a crash?
Yeah, it's such a good question.
I
And
thought
when
so.
I ask myself every day, what do we do? Because we know there's something coming. There's always market cycles, and always right before a recession, there is usually a run up.
Yeah,
If you look at it 10 years ago, everybody was in and paying top dollar, and builders were borrowing millions of dollars to bring in more supply that wasn't needed.
yeah,
And values were through the roof. It was just straight up until it turned and was straight down. And it's same with the Great Depression. When you look at the hype and the growth and the exuberance right before the crash, I mean, it was straight up.
yeah,
So, don't think that just because there's a frenzy and people are excited and things are good and there's been a run up for more than 10 years, don't think that's a positive thing. That's a sign. That's a
yeah,
sign that, there's a waterfall, big one around the corner.
yeah.
Um,
I kind of feel like and people can disagree with this or not, but the banks, you were coming from that mortgage story, and obviously lenders were doing some really, really stupid things before that last crash. And then we got into this situation where we got a lot more regulated as a result of that crash.
yeah.
And I feel like, the lenders are certainly behaving within the confines of those regulations that were established back then, but
hmm
now they're doing different stupid stuff. Just stuff that's not like I know you're very data driven, and my numbers may be slightly off here, but I read something recently that was talking about the previous crash, and the lenders were as far as like the deposits behind what was going on with the lenders. So at the time, most American banks were running, somewhere in that 5 to 7% cash reserve. So in other words, if they took $100 from you, they would keep 5 to 7 for themselves in reserves for safety, and they would loan out the other $93, $94. All right.
hmm hmm
Now, and that's not something that's very regulated, partially because it's backed by FDIC. So
hmm
now the lenders are running less than 1% cash
hmm
reserves because
Yeah.
that's not something that's regulated. And
hmm
they've learned in the past that, the government historically has bailed out big businesses like the lending industry. And so they feel like, well, we have no motivation at all to keep any kind of cash reserves because A, it's not regulated, and B, based on previous experience, it's certainly not required. So,
Right. There's a lot of concern that the U.S. banking system is not as solid as people would like to think.
yeah,
And a lot of people, I mean, if you haven't seen The Big Short, you need to go
oh,
watch it,
I
and
agree.
read it, right? It's like, the unthinkable happened, but we were able to fix the problem by pouring, $5 or more trillion into the money supply to cover the bank lot, to cover the problem.
Yeah,
Um, but so now we've got that to deal with.
yeah,
A lot of people just think that their money is safe in a bank, and it's probably not there. If you think everybody can just go in at the same time and get their money out, you'd be mistaken. And depositors are the lowest on the totem pole. It's those who buy CDs and actually any securities through the bank. They have first priority to any funds that come out, and depositors are last. So they probably wouldn't get it if there was a run on the bank.
yeah,
So the question is, what would cause a run on the bank? And what we know did it last time was massive debts that couldn't be paid. And so we have to look and say, well, where are there massive debts that couldn't be paid today? And there's a lot of them. It's just a matter of when, when that all blows up
yeah,
and how that would affect the banking system. And it could be any day, or it could be years from now. The can could get kicked down the road a lot longer if we have more stimulus, more quantitative easing, the tax reform that's going to stimulate the economy. That's going to put another 1.4 trillion or so estimated back into stimulating the economy. So there's going to, as long as there's stimulus, we can just keep getting through the crisis. But at some point, we'll have to pay the piper. So
it's kicking the can down the road for sure.
Yeah. So you just got to be smart in your investing and not think it's kind of like people, if you've ever had a big equity line, like, or just like an influx of credit. I went to the bank in 2005 or six, and that big old house we had bought, had gone up in value by over $1 million.
Great.
So in just paper, we didn't take the money out, but I went to the bank one day just to make a deposit, and the teller says, "Oh my goodness, you just qualified for a $250,000 equity line." And I said, "Really? What do I need to do?" And she's like, "Nothing." So I remember coming home and going, "Oh my gosh, honey, we have $250,000." And and at first it's like, "Wow, that's a lot of money. What do you want to do with it?" Well, we ended up buying properties with it, but a lot of people didn't. They went on vacation, they bought furniture, they remodeled their kitchen, and then forgot that they had to pay that back. And so that's kind of where we're at right now in the U.S. is like, wow, everything's so great. We got all this money. We can invest it. Everything's booming. Businesses are buying, more equipment, and not realizing that our debt to GDP ratios are 106%.
Yeah, it's crazy.
It's like borrowing 100% to buy a business and getting a very small output from it. People not realizing that there's debt to pay, and we don't know how to do it. We don't know how to pay it.
Yeah, and agreed, and it's the same conversations that we have with all of our investors too. It's like now is really the time to be if you've got any kind of liquidity at all, or you have the ability to borrow, or get a HELOC out of your primary home or wherever you're getting it. You definitely want to be investing in cash flowing real estate. You can't necessarily right now look at the hope of future appreciation because that just given where the market is, that's kind of a pipe dream. But there are still markets where the price to rent ratio is really, really very favorable for buy and hold investors that just want, good long-term cash flow. Because, based on what you just said, like, I agree with you. Like, if you're holding any kind of cash at all, it's not that safe in, your local bank around the corner or a national bank. It's really not that safe. But even if you had a half-assed property that was throwing off some cash flow, you'd be doing far better than what you have in the bank. And even with no appreciation at all, at least you have an asset that can perform.
Yes.
And so that said, I'm kind of curious what you think, based on where we are right now. Obviously I'm a little bullish on India, and maybe I'm a little bit biased, but what do you think are like the top few markets for achieving this kind of good price to rent ratio and good, buy and hold returns right now?
Yeah, well, I can speak from personal experience that I went through, as all of us did, the worst housing crisis in my history, and since the Great Depression. And the properties that we bought and that many of the members at Real Wealth Network bought never felt it. Those who bought in the areas that we suggested that were near jobs and the population growth and the path of progress, and we knew that the city was reinvesting in itself, building that new freeway. All that happened to us was our rents went up. So
great.
The values never went down. Even if they did, we wouldn't know or care because our rents were going up. But those investors, they doubled their equity, never felt the recession, and only got raises. And so, why during the worst housing crisis were those tenants in those neighborhoods able to just keep paying the rent? It's because what you just said, we were in affordable areas. We were in attractive areas near jobs that weren't affected by the recession. We were the cash flow was so high that even if rents went down, which they did not, we would have been fine, fine, absolutely fine, because the mortgage was so much lower than the rent. And so, I got nothing but love mail from the investors who listened to me, because they sold at the peak in California.
Yeah.
And, they would have lost everything, but they sold at the peak and exchanged for low cost, high cash flow properties in a booming market. So, you fast forward to today and go, today feels a lot like 2006.
Yeah, it does.
We're
Yeah.
like way above the last peak of 2006 in a lot of markets, certainly California, a great time to sell and exchange for properties that make sense, just like I just said. So where are the markets where there's stable job growth, where you still get, good cash flow from tenants who have jobs that won't disappear and that, will be able to continue to pay?
Yeah.
Where are those markets? I mean, they're going to be in areas that that just really don't get that affected by these recessions. And, certainly Indianapolis is on that list. Not all of, I'm sure you would agree that there's parts of Indianapolis that will get hit.
Yeah, I think so.
Yeah.
I don't think it's going to be nearly as bad as what happened last time, because Indy is a very different city, and you had kind of touched on some of that stuff, that cities that are willing to invest in infrastructure and things like that. There's been some really amazing initiatives, even just in the short year and a half that I've lived here. It's been really just transformational. So much money being put into, roads and bridges and community centers, and they up their police force by 35%, and it's just an amazing renaissance that's going on. But that obviously does put a little bit of price pressure on things too. One of the things that and again, not a commercial for Indy, because I agree with you. There's plenty of other markets that you could do this in. I've even honestly been hearing positive things about Detroit lately, and for whatever reason, obviously they got hit so bad that there's just been this, horrible stigma about Detroit. But there's some really interesting things going on there, and that city is really starting to turn around again too. But
no doubt. I just took a group of investors there on a bus tour, and that's exactly what I've helped investors do since 2004, when I was on a mission to figure out this passive income model. Is, where are the places where you can still get deals?
Yeah.
And in today's wild and crazy markets, where so many markets have ballooned, the strategy is to go into the areas with a poor reputation. So Detroit is a perfect example of that. People just think it's a mess. They don't want to go near it. They're afraid of it. And a couple of years ago, I would have agreed. But because our antennas are always out, and we learned that two billionaires have just taken on the city. They love the city, and they have invested a couple $1 billion each to completely revitalize it. And it's become a millennial hotspot. It's absolutely gorgeous. There's construction happening everywhere. And yet, because it suffers from a poor reputation, you can still get bargains.
Oh, yeah.
And you can still get double-digit cash flow. So we're all in Detroit. We're all in Cleveland, all in Pittsburgh. These are areas where the city is investing in itself, improving itself, attracting jobs, doing exactly what Texas did, which was, we're going to make this an attractive place for people to do business, because they're finding that it's impossible to do business in places like California.
Yeah.
So Pittsburgh, Pennsylvania is second to Hollywood in film production. And, who knew that? Google moved its East Coast headquarters there.
Yeah.
And then Cleveland's become a medical hub, and Detroit is just booming all around. And Indianapolis, all you have to do is drive there to see the massive growth happening there. And yet, certain areas people just don't know about. You don't have some Iranian, billionaire going, I really want to invest in Anderson, Indianapolis.
Yeah, exactly.
They're not doing that. They're going to Vegas. They're going to Atlanta. LA, San Francisco, New York, Miami.
They want sexy.
So they want sexy, but I want cash flow, and it does exist. Yeah.
I agree. One other asterisk that I wanted to put on something that you said is historically what we've seen when we've gotten into bubbles, and you were talking about rents going up in that previous crash. And this is just my take on it, Kathy, but I
Mm-hmm.
believe that they go up because when there's so many people that default on their mortgages, those
Mm-hmm.
people then go out into the rental market. They've still got to have a place to live. Like
Yep.
eventually they get kicked out of their house.
Right.
And again, I don't know if what's coming is going to mirror exactly what happened a few years ago. I think there'll be some similarities. I don't think it's going to be identical, but I think we're still going to see a run of people having to get out of their primary residence and at least temporarily having to participate in the rental market as a tenant. And
Mm-hmm.
that just puts a whole lot of, demand pressure on the rental market, which
Mm-hmm.
automatically causes rents to rise.
Right.
So, if you're playing that, buy and hold, cash flow, the good return game, then you don't really give a crap about the value of the property at that point. You're just going like, okay, well, I've already paid for the property. The price was fixed. So it doesn't matter what the value is. I'm in it for X. And if Y is my rent, and now I'm still in it for X, but now my rent is Y plus 2, like you're a very happy investor at that point, even when
That's
when
right.
everybody else is trying to jump off the bridge. So so
That's right.
I think that I agree with you. I think there's some really, really great things that investors should be looking at for great places and great opportunities. And I obviously it's not an appreciation, but it's in, right now it's in kind of a buy and hold and cash on cash return and that sort of thing. So um, I don't know if you agree or disagree, but it sounds like you agree.
Yeah, absolutely. Yeah. I have a lot of really high level economists on my show, and they repeatedly say, there's a couple of ways to protect yourself. One is being in short term deals, short term flips. Uh, you know, uh, to own properties free and clear. You want to be careful about leverage, being over leveraged. That's where people got in trouble last time.
Yeah.
And and then in high cash flow markets that tend to be linear, that have that just aren't affected. They're not. You've got if there's going to be a stock market collapse, who's it going to affect? It's going to affect people who invest in the stock market. Is that the Midwest? I don't know. I don't
Yeah. Well,
I don't think so. You know.
that's a whole nother podcast. But
So yeah.
here's my big question for you because I know I kind of wanted to reconcile what I said at the top of the show about our title. I mean, it's clear you're like super passionate about things and it's really great to see that and I just love your excitement. But I know deep down you're kind of a data nerd.
Oh
And
yeah, I am.
I'm wondering, like, I mean, obviously you've got a really good balance of being the data nerd and being the, passionate about real estate investing because what it's done for you. I mean, whether the listeners know that or not, I know you live in Malibu. I mean, the lifestyle of living on the beach in California. It's awesome, right? I mean, it's
Yeah.
expensive to live there, and it's to a certain extent
Hmm.
many Americans dream to live like that. But
Mm.
what in an effort to achieve that, and being a data nerd, what do you think? What's the best advice you could give investors out there as far as the less obvious metrics that investors typically don't pay attention to? So,
Hmm.
being the data nerd that you are, what are the kind of metrics that you may want to talk about
Sure.
that might enlighten some investors that haven't really thought, down that angle?
Well, it really depends on the audience. My California audience, they have a lot to learn. They don't know cash flow. It's not even a word they have heard before because they've never had it.
Because it doesn't
You know,
exist in their neighborhood.
yeah, they're used to buying a property, holding it, and making a few $1,000,000.
Yeah.
That's how you do it. So the concept of cash flow doesn't even exist. So with them, we have to just sit down and kind of go over numbers and say, are the fundamentals in place? So it's really helping people understand the pro forma, and that if you're betting on appreciation and you buy at the peak, it'll probably be 10 years before you actually see any growth at all. Because if you buy at the peak, then you have to wait through a recession and then another buildup. So
Yeah.
anyone who bought in California at the peak in 2006 is just now making their money back. So
Yeah.
people always
Wow.
say, oh, but you make so much money in California. Only if you buy at the right time. If you
Yeah.
buy at the peak, you sit for 10 years just hoping to, not lose money, to get back the money you lost in the downturn. So, for California investors and those who are appreciation investors, you need to learn the fundamentals. And we teach that at realwealthnetwork.com constantly to help people understand. Now, for the sophisticated cash flow investor who's just like, hey, where do I buy? Where do I get cash flow? Probably the most important metric that we look at is job growth versus like permits. So we don't want to be in an area that's overbuilding. We want to understand where the jobs are going, what those jobs are, and if they can sustain a recession. So, if a company, let's take, I'm sure you've got examples, but let's just take Kansas City, for example. A huge company is coming in called Cerner, and they provide, I don't really know what they do, but all I know is they're building a huge campus just outside of Kansas City. I don't think that's just going to just like suddenly disappear. I'm guessing they have reserves. I'm guessing I believe they're in the medical world, but not totally sure. But that's a situation where you've got lots and lots of money being invested. Probably that industry has thought about a downturn and has set reserves aside for that, so the jobs will continue.
Yeah.
So that's a great buy. I know you've got a lot of that in Indianapolis. I know a lot of the automakers are moving to the south. If you're going to build a big auto factory, it's you probably thought through the cost of that, and how to get through a downturn.
Yeah. Hopefully.
And yeah, hopefully. So. Like that's one of the reasons we're building in Reno, Nevada. Is Tesla is building its battery factory there. Tesla appears to me to be a company of the future, not the past.
For sure.
So building houses in Reno where there's a desperate need for housing, that feels like a good plan. Another metric, we look at it. So it's like, where's the job growth, where's the population growth, and what are the permits? What's being built? If the wrong thing is being built, that could be a problem. Like Chicago, you've got over 65 high-rise luxury condos going in. So, not 65 buildings being built.
Wow.
High-rise buildings with luxury condos. Is there a market for that? I don't know, but I would be concerned.
Yeah.
Whereas in Chicago, are they building affordable housing? No, because it's too hard. So if you can get in the affordable housing, if you can buy an old house and renovate it for much less than it would cost to build, you're probably going to be fine in any market, because builders just cannot build affordable housing. There's too much that they're pushing against, too many new regulations, lack of labor, supply costs. It's just, if you can buy an old house and fix it up and make it affordable, that is the future, and that's where you're going to protect yourself. So those are just some of the metrics.
Yeah, I think it's interesting too, and I appreciate all those insights. It's great when you, especially, talking about, job growth versus permits, and, looking at, why certain cities are growing and what kind of companies and technologies are coming in there. Those are just really, really great insights, and I'm certain. I mean, I know I got a lot out of just visiting with you, and so
Thank you.
I don't even really know what else to ask, because you're just like such a wealth of information. But I'm going to ask my favorite question that I do ask a lot of guests is this. This is the trick question. What is the question that I didn't ask you that I should be asking you?
Ah, good one. I would probably say, where am I investing?
Yeah, let's go there. That's a good one. Where is Kathy Fettke investing right now?
Well, if I could even slow down for a second, I would probably buy a bunch of properties in just like I said, cash flow properties in Cleveland, Detroit, Indianapolis, and parts of Florida, because Florida is going to boom from the baby boomer migration there.
Yeah.
So if I could give myself a few hours to do that, but meanwhile, we are just busy raising money to, give capital to builders to just build more and more in the right areas. And so, I actually just realized I can't even talk about it because it's a private placement. I'm not allowed to advertise it, but
you didn't hear that.
But yeah, some really, really exciting build projects, getting land from people who got into loans to short-term balloon notes. That's something you should be cautious of, because the reason we get deals for, such amazing deals is because somebody's in a distressed situation from debt. They took on a short-term loan that balloons and they're going to lose the whole property, so they sell it to us for massive discounts. Yeah. So don't do that. But if if you want to,
unless you're on the buying side, yeah.
On the buying side, it's great.
Yeah, absolutely. Yeah, and if done right, you're still helping out the person that needs to get out of debt, and it's definitely, it's probably not their brightest moment, but it's still providing a solution. And
we try to make it a win-win for sure.
Yeah, absolutely. Yeah, and I that's the definitely the philosophy that Jack and I live by, and I think at least the good investors and the highbrow investors, like, look, you don't want to do stuff that's just a win for you and not for anybody else. I mean, there's no question that any real estate transaction can be a win-win for everybody. I don't care. I don't care what it is. I think it's it's just all dependent on how it's postured. And so anyway, yeah, I really, really appreciate your insights. And so I know that your website is realwealthnetwork.com. And we will definitely put a link to that in our show notes. Okay. Is there anywhere else that if somebody wanted to get a hold of you, like, what's the best way to do that?
The best way to reach me is to go to realwealthnetwork.com. It's free to join. And when you join, you get access to a lot of the data that we do geek out over on the different cities and where the job growth is, and the parts of those cities where jobs are going, and the low crime areas. And so we share that data. And then you also have access to some of the other things that we're doing that we can only share with members. Sure. So, that's free to join. And then you can, from there, schedule, once we have a little more information on what you're trying to achieve, we can schedule a one-on-one. So that's the best way. Great. At realwealthnetwork.com. But you can also listen to my show, The Real Wealth Show, and you can read my book, Retire Rich with Rentals, that you can get from Amazon.
Okay, and I will Retire Rich with Rentals. I will make sure that we also put a link to the book on Amazon on the show notes as well, so that any of the listeners can go there and find that easily. And I don't really have anything else other than just like 12,000 thank yous to you, Kathy. I mean, it's really, this has been great. I know your path and my path have crossed a few times just in different, real estate investor networks and forums online and things like that. And I know we know a couple of the same people, but it's a pleasure to be able to have a, deep conversation about some of this stuff and to learn a little bit more about you. And thank you so much for all the great insights and just in general for the great value that you put out there to the investing community. It's I'm just going to say thank you on behalf of all investors.
Thank you so much. Really appreciate that.
My pleasure. Thanks for being on the show, and thanks everyone for listening, and everybody have a great day.